Lower stocks after that better than expected jobs report. Yields are higher, rate cut hopes are lower. We'll trade all of it with the investment committee. Joining me for the hour today, Joe Terranova, Carrie Firestone, Jenny Harrington, and Brian Belsky. All right, so we've been around the way a little bit in the markets, but we are settled lower across the board here. Slightly for the S&P, slightly for the Dow, a little bit more for the Russell, again, on that rate move higher. So, you know, are stocks lower because you put the rate cut hopes on the back burner? Are they lower because rates go up? I mean, Beth Hammack yesterday, the Cleveland Fed Pres, was like, I think we're going to wait a bit. We need to be patient on rates. Don't expect much anytime soon. What do you think?
I think that's a question that gets answered on a secular perspective, not really on a cyclical perspective. I think what today's jobs report did is it validates what I said yesterday. Bond market volatility is calm. That's good for risk assets. As far as what's troubling the market today, I think it's a little bit of a rollover in crypto.
Troubling in quotes, obviously, right?
Yeah.
I mean, S&P's flat.
Right, exactly. A little bit of a pullback from where we were yesterday, the enthusiasm we had for it. But you got a little bit of a rollover in crypto, the momentum names, and software. So software had a nice run the last couple of days, and it looks like software is kind of rolling over a little bit. We'll see what happens from there.
So, Jenny, you know, Bespoke puts out this note. For the first time in its history, the S&P 500 went from overbought to oversold and back to overbought in a week or less. It speaks to kind of how frazzled the last week of trading has felt.
Yeah, and I think the only way you can contend with that and stay sane is to push out your time horizon. And I think if you're an investor who's investing for 1 year, 3 years, 5 years, 10 years, the frazzle and the insanity of last week has a lot less negative impact on you, because weeks like last week, they can make you behave very poorly. They can make you make very stupid, panic-stricken decisions that have long-term negative impacts on your portfolio. But if you take the approach that I do, where you say, I tune out the short-term noise, I focus on the horizon, I know where this company's going, I'm going to focus on valuation, even if for, say, 3 years or 5 years, valuations don't matter, ultimately they do, then if you can focus that way, it helps you keep your wits about you. So maybe if you are a shorter term oriented investor or a trader, maybe when you see it get this crazy, just pretend to be long term for that week or two.
Yeah, well, or maybe even longer than that. You know, Carrie, Tony Pasquarello over at Goldman Sachs today says, I can't recall a time that was this noisy, this high velocity, this wide open. Others say they can't recall a time that was this expensive. Now, David Einhorn was just on, says, I think this is the most expensive market that we've been in. Says the Fed is going to cut, quote, a whole bunch of times, many, many more than is currently priced into the market. What do you make of both of those gentlemen sort of opining on where we are?
Oh, gosh. Well, David Einhorn is a very smart guy, and he doesn't speak very often.
So is Pasquarello.
So, very smart. So I would say there's pieces of what they both said that are true. Yes, the market is expensive. You can't deny that fact. There are many reasons that it's expensive. One of them is because there aren't as many stocks to buy. I mean, we're talking about shrinking market cap, and that inflates the value of everything. And earnings have been good. Coming out of COVID, we're still having the post-COVID high to some extent. Is there a reason to be particularly concerned? I would say that's a more important factor. What should we be most concerned about? Well, if we're not going to have the kind of slowdown or softish growth period and employment is strong and inflation is also hot, I think.
But it isn't, right? But it isn't.
We don't know for sure. I mean, the market is skittish.
Well, we know now.
Fact.
We do know now. I mean, if you want to say, well, we don't know if it's going to start ticking higher again. Yeah. I mean, that's fair, but we don't know, you know, what the weather's going to be a week from now.
Correct, but we have earnings that are growing nicely, but not great. I mean, exceeding expectations.
They're way exceeding expectations. Ed Yardeni says the earnings season is among the best ever.
Yes, I understand that, but relative to it's always supposed to be the best.
They're ahead of expectations.
Only in aggregate.
6 months. Yes.
Right,
Yeah.
but it's only great in aggregate, and this has been my beef all year. Like, and we both know this, as portfolio managers.
Yeah.
You take it in aggregate. There's a few big things that buoy the whole thing up. You disaggregate it. You look at the other 493. It's not as rosy a picture.
I don't know. Earnings have been pretty darn good. We're not. You're talking like you're talking. Well, you pick one stock out of a hat.
I can tons.
You're saying everything outside of the mega caps in terms of earnings. You said look at the other 493.
Only because that's a lot of stocks. I'm not saying the mega caps are the only ones buoying it up, but I'm saying in aggregate, growth is there. Once you start to disaggregate, it's not. It's not as good a picture.
What do you think? You warm enough over there?
I am. It's it's all about layers. Quite frankly, it is.
Everybody loves layers, though.
There's a lot of layers to this conversation already.
I'm a big red onion. Okay.
Haven't earnings? I mean, if Einhorn says, I think this is the most expensive market that we've been in, someone like Ed Yardeni would say, that may be true, but justifiably so. Look at where earnings are.
Yeah, I love Ed's comments. We can, not just because we agree, but we kind of come from the same vintage, and he's talking about some of the same things that. Yeah, we do.
No, you don't.
Go ahead.
Okay, just continue. We're in the process of transitioning in this fourth year of the bull market from a momentum, multiple-driven market to an earnings-driven market. When we wrote our year-ahead piece for 2026, we talked about traditionally and historically over the last 80 years when the S&P 500 moves into more of an earnings-driven market, the returns are roughly half what a momentum and multiple-driven market. Doesn't mean it's not going to be positive. It's still positive. That, to me, is a much more fundamentally driven market. And what's happening with the market and with the participants with these binary moves, buy, sell, there's a big disruption between short-term, intermediate-term, and long-term. And I think at the end of the day, what the market's showing you is that other areas of the market are working. Dividend growth, value, small cap. And the more that they work, the more credibility they have. The more credibility they have, the better performance. So performance begets performance, and we continue to think that those areas will continue to lead in this broadening out.
Barclays today upgrades value, downgrades momentum. Joe, you can go on that, and cautions on small caps. Like small caps got out of the gates like a Ferrari to start this year, and then that's obviously cooled a bit. There is the rates question. There was a bit of is the economy slowing question, but then you get this hot jobs thing today, and who knows? But upgrade value, downgrade momentum. You say what?
So the broadening thesis is supported by earnings, and it is not just domestic. It is in the emerging markets. It is in areas like industrials and financials, and it's in small caps too. Small caps finally are seeing on an annualized basis positive earnings. Momentum can go to different places. Momentum can reside itself in high beta. Momentum can reside itself in low quality. And what momentum is currently doing is it's pivoting more towards quality and more towards value. So there are names that we identify as value. There are names we identify as quality that have established momentum. That is what the momentum factor ultimately does. Now, is the momentum factor outperforming the rest of the market like it has since the first rate cut in September of 24? No, it is not. And I would argue that's a healthy condition for investors.
Okay.